Hey there, Prof. Aram here, and in this video we're going to look at some of the features of common stocks. So let's get to it. One of the main features of common stocks is that when the company issues shares to public, the founders give out control, meaning that now the shareholders, the individual investors and institutional investors have the right to vote on the major decisions for the firm. So every year in the annual meeting, the shareholders can go and vote for electing the new directors for the board of directors, or vote for mergers and acquisitions, vote for different major decisions that are going to be that are going to be made for the firm. So as a shareholder, you have the right to go to the annual meeting and vote for the new directors and vote for the new measures that are going to be adopted by the company. So that's the right, one of the rights that you receive by investing in a common stock of the company. And of course, you have the rights to the residual cash flows of the firm as well, meaning that in the case of bankruptcy, if when the bondholders and other creditors are paid, whatever is left, whatever is the residual, is going to be for shareholders. The other feature of common stocks is that if you're not able to go to the annual meeting, you can vote by proxy. This is like an absentee ballots that we have in general elections. So let's say there is a fight between an institutional investor or an activist investor with the management. They may ask for your proxy votes. So because they want to gather as many votes as possible to go against the management. So you can vote by proxy. You can give your votes to that activist investor. Of course, if you like their agenda, then you can give your votes to the activist investors. There are some situations where companies have multiple classes of stocks. For example, Class A shares and Class B shares. And especially in recent decades, technological companies have this setting where usually the founder owns one class of shares and the remainder of the investors, the outside investors, own the other class of shares. And this, for example, in case of Facebook or Meta, Class A shares, all of them are owned by Mark Zuckerberg and other founders, and each stock or each share has 10 votes. But the other shares that are held by outside investors, each share has 1 vote only. So these dual classes of shares can happen too. The other rights that common stock owners have are share proportionally in declared dividends. So whenever the company declare, let's say, $100 million in dividends, then you're going to receive dividends in proportion of your shares. And then share proportionally in the remaining assets during the liquidation. So if the company goes bankrupt, whatever residual amount is left after paying off all the creditors, you're going to share that proportionally. Preemptive rights, usually the current shareholders of the firm have the first shot at the new stock issuance to maintain proportional ownership if they want. In other words, when the company issues shares, usually there is a dilution effect of the current stock owners. The current stock owners' equity is going down. The proportion of the company that they own is going down if the company issues new shares. So if you want to hold the proportion of the company that you had before, you can buy more shares if the company issues the stocks. You're going to be the first in line to buy those shares. In terms of dividend characteristics, you should know that dividends are not a liability of the firm. In other words, no firm has ever had to file for bankruptcy for cutting dividends or omitting dividends, right? Because they're not a liability of the firm. But if the board of directors declare a dividend, then they will become liability of the firm. Consequently, as I said, a firm cannot go bankrupt for not declaring dividends. Dividends and taxes, dividend payments are not considered a business expense, therefore they're not tax deductible. Unlike interest expense, dividend expense is not tax deductible. If you hold the stock for a short period of time, you pay more taxes on dividends than if you are a long-term investor. And then dividends that are held by corporations, so if, for example, firm A owns shares of firm B and firm B pays a dividend, firm A only pays taxes on 30% of those dividends. The remaining 70% is tax free. In terms of the preferred stock, the dividends of the preferred stock, the stated dividend must be paid before the common stockholders. So they are, they need to get paid before common shareholders are getting their dividends. Dividends are not a liability of the firm, so preferred dividends can be deferred indefinitely. But when the company decides to pay off these dividends, they have to be paid before the common shareholders. These preferred dividends are cumulative, so if the company defer them, they're going to accumulate over time. So that's why any missed preferred dividend have to be paid before common dividends can be paid. And keep in mind that these preferred stock owners, because they're promised to receive dividends, they have to give up something. And usually what they give up is the voting rights. So I hope you find this video useful, and thanks for watching.